quote me on the numbers displayed for discussion. So you can chat me as well. So we can let you know how you can be of help to us. I am Jeremiah Ajiradusu, the author of JAT's Business and Financial Accounting. Okay, we are back again because we had a little bit of some rest. We take care of ourselves too. Okay. Good to have you back. Okay. Okay, so we are going to be looking at something. What do I call it? Okay, you remember your basic tax computation. Okay, of course, you at this level you should understand that there's something called tax account, and your tax account is different from your financial accounting report. So there's an account that is prepared for tax purpose. There's an account that is prepared for reporting purpose, of course, management report. Okay, and now, of course, your basics of tax computation. Of course, after preparing your report, your comprehensive income statement, there's a net profit there, right? Then for tax purpose, we pick the net profit, and then we'll now start adjusting. So there are some incomes that you ought to have reported in the financial account that you did not report. Of course, they will add it back. There are some expenses that you ought not to have deducted. Okay? Of course, they will add it back. Of course, there are some incomes, okay, that you have reported that you ought not to have reported, they will deduct it. And then if we have some expenses that you ought to have deducted, but you didn't deduct, they will deduct it. Of course, after that adjustment regarding allowable expenses, non-allowable expenses, allowable income, non-allowable income, then you have what they call your assessable profit, right? On which you apply your education tax. At this level, you know all that. And then you now take into consideration your loss reliefs, your capital allowances, your balancing charges, and all that. Or balancing adjustments, rather. And then you now apply your what? Your company income tax, right? Okay? So, but then that means that based on the computation of the tax return, or let's call it tax account, Abi, and then the computation of what? Of the financial report. Of course, it will mean that the profit reported here, okay, will most likely not be equal to the profit reported here. So it means that the profit reported here can be greater than the profit reported here. The profit reported here can be less than the profit reported here. So what it now means is that the tax expense based on this will also not be equal to the tax expense here. So it also means that what? The tax expense here can be what? Greater than the tax expense reported here. The tax expense here can be less than the tax expense reported here. So you can see that there's a difference between the tax reported based on financial report and the tax reported based on what? The tax what? Account. And now that difference, we must be able to identify if the difference, if it is permanent or if it is what? Temporal. If it is permanent, it means that there's no possibility of it reversing in the subsequent accounting period. So here we say no reversal possibility. But here, we say what? There is reversal. So it means that if the difference in the tax computation based on financial report and the tax return, if it is a temporal difference, it means that there's a possibility of having a reversal in the subsequent accounting period. So what it means is that as we report subsequent periods, that difference will be reconciled. So such scenario, we refer to it as deferred tax income or deferred tax. Now there's an accounting aspect for that we're looking at today. So we're looking at what? Accounting for what? Deferred what? Tax. So I would advise you also look at IS 12 on taxation. That's where the board has recommended treatment for what? Deferred tax. So you should look at that. But let's just look at what we are looking at here now, so we understand basically what we're talking about. So there are different, there are items that can cause differences, basically resulting from, you can say, evaluation of assets, upward valuation of assets. Of course, there's no sales. You can even say depreciation. How do we capture expenses? How do we capture income? The way we capture the income based on financial reporting might not be the way income is supposed to be captured based on the tax law. So that can cause differences. So that difference, once it is temporal, it means that we can recoup or reconcile differences as time goes on. So we'll call it temporal difference or timely what? Difference. So if the difference occurs in this year, as we report next year, we'll be gradually reducing the difference. Okay? So let's take a very simple example. Depreciation, for instance. Of course, your depreciation in financial reporting is not depreciation in tax. So usually they use capital allowance. So let's say an asset of, let's say 10,000. Okay? Of course, if you are depreciating, we can say we will depreciate over 4 years. So financial reporting depreciation, if we depreciate over 4 years, it means every year we are having 2,500. But for tax returns or tax accounts, of course, let's assume that there's an initial allowance of what, 50%, and then we have 20% annual. So it means that in the first year, while financial reporting is taking 2,005, this one here, tax report, we first of all take half, which is 5,000, before it will now take another, what, 20%, which is like 5,000 divided by what? 4. Okay? Are you there? So if we do 0.2 times 5, so what do we have here? 10% is what? 5. And that's what? What do we have? 20 over 100 times 5,000. 0, 0, 0, 0. So what do we have? This is 1,000. Okay? This is 1,000. Better still, let's say, okay, this is 5 years. Let's make it 5 years here. So that means this, let's make it 2,000. So we understand what we're saying. So let's even assume that financial reporting wise, you're still using 5 years. Of course, that will be 2,000 per year. But for tax return purpose, there's an initial allowance of 50% and allowance 20%. So that means for the first year, the initial allowance will be 5,000. Then 20% for the first year. That means for this first year, while financial reporting is taking 2,000, what's his name? That account is taking 6,000. Okay? So it means that subsequent years, of course, this will maintain 2,000 for the next 4 years. But for this one now, it will not be 1,000. So this first year, you can see that depreciation here is 2,000, here is 6,000. That means the profit that you report here will be higher than the profit that you report here based on the what? The effect of the depreciation. So, but the next year, while you maintain 2,000 here, you might be maintaining 1,000 here. So that means here, the profit will not be what? Higher. Here it will be what? Lower. So you can start gradually, the differences will be what? Reconciled. Let's take an instance. Okay, based on this, let's just maintain a stable what? Sales. Let's say we have 20,000 in the first year. This is financial reporting, this is tax. Of course, depreciation here is 2,000. Let's even say we have all allowable expense of 10,000. So if you take that out, you have 10,000 here. Let's say here too is 10,000. You still have 10,000 here. But based on depreciation here now, you took 2,000. So that means your profit will be what? 8,000. But here you're taking 6,000. Profit will be what? 4,000. So as you can see, this profit here is 8,000. Here is what? 4,000. So if you apply your tax rate here, the tax expense here will be higher than the tax expense here. Okay? So it means that the tax you're paying on 8,000 based on financial reporting is higher than the tax you're paying based on the tax account for that year. So there's a difference. But as you continue reporting, you'll be seeing that the difference will be showing. Here in the next year might be lower, while here will be what? Higher. So tax computation will be higher than tax computation here. So it will be gradually what? Reversing. So for deferred tax now, you can have a deferred what? Tax liability. You can have a deferred tax what? Asset. Okay? So let's assume that the financial reporting profit or the tax computed based on financial reporting profit. Let's assume tax based on financial reporting profit. Let's assume it is what? 1,000. But the tax computed based on tax return, let's assume it is what? 800. You can see that the current year tax is 1,000, but the tax computation is saying it should be what? 800. So that means that what? For this year, the actual cash you'll be paying is what? 800. So that means if we're going to be crediting cash, it will be what? 800. But our current year tax is showing what? 1,000. So it means that while you're crediting your cash with 800, right? You're going to debit current year tax with what? 800. Of course, there's still 200 remaining, Abi. So that means you would what now? Debit your current year tax with what? 200. And then you now credit your what? Deferred tax what? Liability with what? 200. So it means that we are going to be deferring 200 out of this what? 1,000 to be reconciled in the following what? Year. So when we now prepare the account for the following year, we expect to have that difference reconciled. So gradually we'll be reconciling until what? Your deferred tax will not be what? New. Now it is also possible to have deferred tax assets. But in this case, it means that what? Here, your tax financial report is showing, let's say 800. Now, your tax account is showing 1,000. What this means is that what you computed based on financial account is 800, but what you computed based on tax is 1,000. So what that means is that your actual cash that you'll be paying, now this one is for liability. Now let's look at the one for assets now. What this means is that now for asset, now it means that the actual cash you're paying, credit now will be what? 1,000, which is what? Cash. So here, you're crediting your cash with 1,000 based on what? The tax account computed. But you're debiting your current year tax, which is 800 that you have completed, right? But you're paying excess, which is what your D is now going to be an asset. Your D5 will be what? Asset of what? 200. So it means that this 200 now we appear as what? As an asset that you reconcile in the what? Following period. But in this case now, this 200 is what? Is a liability that you reconcile in the following what? Period. So what I'm saying is that where your tax financial report tax expense is higher than what the tax computation is saying, you're likely to have a deferred tax asset. But where your financial report tax is higher than what your tax return is saying, you're likely to have what the deferred tax what? Liability. Of course, based on the what? Condition that what? As time goes on, you'll be what? Reconciling the difference, and eventually it will what? Nil out. That what makes it what? A temporal or timely tax difference. So there is a reversal possibility. That is what will now give birth to what? Deferred what? Tax. So it means that year in, year out as a report, you must reconcile your financial reporting tax position with your tax return tax position. And whatever difference you have that is temporal, of course, is accounted for via the deferred what? Tax, either as an asset or what? As a liability, which will be reconciled as we keep what? Reporting. So of course, if your what? Tax computation is higher than your financial reporting, then you might have an asset, and when it's less, you might have what? A liability, and that definitely will be reversed as what? As we proceed reporting year in, year out. Okay, so this is basically a summary of accounting for deferred what? Tax. All right, so what it simply tells us, or what it's trying to explain to us, is that when there's a difference between tax reported based on what? Our tax laws, and based on our financial reporting principles or laws, we what? Defer tax in form of liability or defer it in form of what? Assets. Of course, based on the fact that as we keep reporting over the years, it will nil out to what? Zero. So this is a summary. If you have questions, don't forget you should go through your IAS 12 on taxation. If you have questions, you can reach my number as displayed. I'll get reply with the right answers. Okay, let's take this very simple question so we can understand what we're talking about here. Okay, so that's, but don't forget we still have the textbook here, study pack for orders, personal orders, sponsors. For those that have sponsored, we appreciate you. So let's go. So we have the following trial balance has been extracted from the books of Judah Mega Pairs for the end date and 2018. We have sales, cost of sales, admin expenses, selling expenses. We have non-current asset debtors, deferred tax. So fine, that means there has been a tax liability coming, deferred tax liability coming from the previous period. So we have cash at bank, vendors, then we have the ordinary share capital there. Then they said, additional information, the tax account prepared for the reporting period showed the tax expense of 18 million higher than the tax expense reported by the financial report for the same period. Accrued expense amounted to 2 million. Business depreciate non-current asset at 10% per annum. The business provides for tax at 2%. Then they say prepare income statement and then statement of financial position as at 2018. So this is already something that you should be used to now. So we have Judah Mega PLC. Okay, so let's say income statement for the year ended 31st December 2018, right? So we'll call this notes. Okay, so notes 1, that's our turnover. So here, let's call it our note 1. So that's what? According to the question, we have sales. Sales there is 420 million. So we have 420 million. So here is 420 million. Note 2, and our cost of sales. So what do we have there? Cost of sales, exactly. At this level, you should know items that make up cost of sales, your inventory, purchases, returns, and all that. So here we have 190 million. So we have 190 million. So we have 190. So if you take this out, 0, 0, 0, 0, 12 minus 9 is 3, 3 minus 1 is 2. We have 230 million. So this, we call it gross profit. Some businesses will require that you include gross margin, because that's the percentage of your gross profit to your turnover. We'll take that in another class, okay? So let's go now. We have our expense, total expense there. Let's call it note 3. So what's our note 3 here? We have admin expense here. What do we have there? 35 million. What do we have again? Admin is 80. So selling expense is 35 million. These are the question. So what's the next thing there? Accrued expense. 2 million. Of course, this will also increase your liability. It's an adjustment. So we have what is depreciation. We have our depreciation here. So it's 10%. How much is the non-current asset there? 180 million. Excuse me. So that's 18,000. Okay. So we have the total expense there. So if you have total expense, so what's total expense there? We add up. This is 30,000 plus 35,000 plus 2,000 plus 18,000. This is 85,000. So we have, if you take this out, what do you have? $145,000. So this is your profit for the year. You can call it profit before tax, right? So what's our tax? Based on the financial report, they say tax is at 32%. That's our provision, right? So 0.32 times 145,000. So this is at 32%. What do we have? 46,400. This is our tax. So that means our profit after tax will be this minus this. $98,600. So what's your earnings per share? Earnings per share, let's show that here. Okay, so should we just call it note 4? So we have note 4. So what do we have now? Profit after tax is what? 98,600. So we have units of what? Ordinary shares. Okay, that's how many units? 100 million. That'll be 100,000. For now, our earnings per share will be what? 98,600 over 6,400. So what do we have there? What do we call it now? 99 kobo or 98.6 kobo. So this is 99 kobo. Approximately 98,600 divided by 100,000. 99 kobo. Okay, so we've gotten the earnings per share. Okay, for here we have to now adjust for deferred tax. So deferred tax adjustment. Excuse me. So financial reporting tax for the 6,400. Okay. So tax returns tax now, or tax returns computation, anyone wants to call it. The question says it is 18 million higher than that reported by financial report. So that means this one is 18 million higher than this. So that would be what? For the 6,400 plus 18 million. Okay, so that's equal to what? 64,400. So you can see that the return tax 64,400 is higher than the financial report tax of 46,400. So that means there's a deferred tax asset. Okay, so that means the cash outflow, technically, if you're assuming you're paying immediately, the cash outflow will be this. Okay, so we have deferred tax asset of what? Of 18 million. So that means what will happen? We're supposed to what? Credit cash with 64,400. Then we're going to debit what? Current year tax with this 46,400. Then we also debit what? Deferred tax asset, right? To what? 18,000. So what is the debit balance? But then there's already a deferred tax liability that we are carrying forward. So that will now offset it. So that means that's what? Deferred tax liability, right? Will now be what? 32,000 minus 18,000. What do you now have? That's 14,000. So that means that your new deferred tax balance will be what? 14,000. Remember I told you, I said that what makes you have a deferred tax because it's a timing difference, which means that as you continue reporting, you expect the balance to reverse. So gradually, the deferred tax item will net off as we report here in here. So now it has reduced from 32 million to what? 14 million. So let's go. Statement of financial position as at 31st December 2018. So what do you have here? The notes, the assets. So let's call this non-current. Note 5. So what's the non-current asset brought forward now? 180 million. So you take out your depreciation. What do you have? 18,000. So if you take this out, your carrying amount will be what? 180,000 minus 18,000. This is 162. We have 162 million. What's the next one? Current, calling it 6. What are the note 6 items? Cash. Now remember that this entry here, we are assuming that if we are to pay, of course we might not be paying, of course your tax is assessed on preceding year basis. So of course the tax for this year will be paid the following year, but we have to adjust for it. So assuming that we're paying now, this is what it looks like. Okay, but now that we're reporting, most likely we are not paying. Okay, so we're going to have to account for it as a current year tax, while also adjusting for the deferred tax item. So we're still going to be carrying our bank balance to be 109 million. So by the time we pay the tax, it will reduce. But if management is saying let's pay immediately, then we'll reduce this value by this. Okay? So we have debtors. What are debtors there? 50 million. Is there any other thing? No. So we call this 159 million. So we add this. What do we have? $321 million. So represented by what now? Liabilities. What do we have? We have long-term liabilities. What are the long-term liabilities here? That's 7. Of course, what do we have here? Deferred tax. Deferred tax is the long-term liability because it will take more than a year to net off the differences. It's not something that will net off in a year, so it's long-term liability there. So we have deferred tax. If you look at your IS 12, so it has reduced from 32 million to 14. So we have 14 million. That's 14 million. So short-term liability or no current liability now. Into it. What are they? My vendors. What's the vendors there? 42 million. Any other item there? Accrued expense. What do you have? 2 million. So this is what? 44 million. But then it doesn't end there. Remember, your current year tax has not been settled. So it's a liability. Your current year tax is a liability. We've raised journal here though, but we've not settled it. So remember that this is what we reported for the 6,400. But based on the tax return completion, we have 64. So this is what we are going to pay in cash eventually. So we say current year tax, that'll be 64,400. Remember that we completed this based on our report, but the tax is giving us 64. So this is what we're going to pay. So this is what we're going to record as what? We're adjusting for it against the deferred tax. Okay? So what do you have? So we have 108,400. So now that we have it in liability, so when we now pay the cash, credit cash, right? Debit it. So when we now debit it again with this balance now, that will enable us to credit 64, debit current year tax with what? 46,400. Now, when we debit this, okay, we're going to be having something like this, deferred tax asset, okay? Right? So we have a tax adjustment or tax completion. We have 18 million, but eventually we're going to take it out back, okay? Say deferred tax liability. So that will close it. So this is what will now make us have our deferred tax liability, which is already 32 million, to reduce. When this comes here to 18 million, to now reduce to what? That's the carry down. At this level, we should understand that now. So we now have brought down here of what? That's what we are having here. Okay? So you understand that. So what do we do? So what's the next thing there? We've done this. So we have our what now? Reserve. What's our reserve now? Let's call that note 9. That will be the profits for the year. So which one are we taking? We adjusted for this. So this is profit after tax now. So we're keeping 98,600. That's 98,600. So what else? Share capital. What do we have? 100 million. So when we add up, we have 321,000. So this is your total assets. This is your total liabilities. So you can see that we've been able to show our deferred tax adjustment based on this scenario, or based on this question. So here we have our total asset to be 321, about 321. So now the deferred tax liability has reduced from 32 to what? 14 as a result of the deferred tax asset that happened in the current year. So by the time we report the following year, we also expect that this to reduce further. So this is an approach to accounting for deferred tax. So if you have questions, you can reach me on the numbers displayed. I'll be able to reply with the right answers. And don't forget, you can support us by printing the account number displayed or sponsor copies of my textbook. You're working on the volume 2 already. We'll let you know when that's ready. Thank you.